Hi everyone, welcome to my YouTube channel GrowwithSIP. Myself Krishna, I am your authorized mutual fund distributor. In this video, we will try to understand what is a mutual fund, what is SIP, what is lump sum, and which is a better way of investing. We'll first try to understand what is a mutual fund and its benefits. Mutual fund is a simple and smart way to invest your money into various assets. Now, let us understand how does a mutual fund work. This starts with pooling of money. A mutual fund is created by combining money from multiple investors into one common fund. Next comes the professional management. The pool money is managed by experienced fund manager who invest according to the predefined investment objective of that fund. Next comes the allocation of units and the net asset value. Once the purchase is done, the allocation is done in the form of units to the investor, and the value of these units changes on day-to-day basis, and this is tracked via the net asset value, also referred to as NAV. Now coming to the returns and losses. The profits or losses are shared by investors in proportion to the amount they have invested. Key benefit of investing in mutual fund is diversification. Your money is invested across multiple stocks, bonds, and other assets, which helps reduce risks. Finally, we have an expert who makes the selection in the mutual fund. Fund managers select from over 5,500 companies, choosing investments that align with the fund's goal. In short, mutual funds offer professional management, diversification, and a disciplined way to grow wealth over the long term. Now look at this image. It shows how to be a successful investor. The golden rule of successful investing is combination of equity, long term, and diversification. Firstly, let's understand equity. Equity investments helps beat inflation and create real wealth over time. Second comes long term investing. Markets move up and down in the short term, but staying invested for the long term allows compounding to work in your favor. Next comes the diversification. Spreading investments across different companies, sectors, and asset classes helps reduce risk and smoothen returns. Now, to be successful in investing, we also need three people working hand in hand. Firstly, the fund manager. The fund manager brings expertise by managing the portfolio and aiming for better risk-adjusted returns. Then comes the advisor. The advisor helps you choose suitable investment schemes based on your goals, time horizon, and risk profile. Then comes the investor. The most important role of the investor is to stay invested with discipline and avoid emotional decisions. When equity, long-term approach, and diversification come together along with the right fund manager, advisor, and a disciplined investor, successful investment become a natural outcome. Now let's try to understand the evolution of mutual funds in India. Mutual funds were first introduced in India in the early 1960s, marking the beginning of a structured investment platform for retail investors. The first mutual fund scheme was launched by UTI in the year 1963, which is backed by Government of India. So this was a major milestone and played a key role in spreading investment awareness among Indian households. Then in 1993, SEBI regulations opened the doors for private asset management companies to enter the industry. This increased the competition and improved product quality. Then the digitization and SIP. With the rise of technology, investment became easier. Online platforms and systematic investment plans led to rapid growth and wider participation. If you look at the current landscape, we have around 45 to 46 asset management companies managing over 2,500 active mutual fund schemes in India. This makes mutual fund accessible to every type of investor. This journey shows how mutual funds evolve into one of the most trusted and powerful investment options in India. Now let's try understanding what is SIP and what is lump sum. SIP and lump sums are the mode of investments in mutual funds. Choosing the right investment style is as important as choosing the right fund. On one side, we have SIP. In SIP, you invest a fixed amount at a regular intervals of time. It could be monthly or even daily. SIPs are ideal for disciplined investors. They carry relatively lower risk. This helps averaging market volatility and are best suited for long-term goals. SIPs also offer high flexibility. You can start, stop, modify your investment anytime. On the flip side, we have lump sum investing. Here, you invest a large amount in one time. This is a bit on a riskier side, and this has to be done by a seasoned investors who are experienced and who have awareness of the market cycles. However, this lump sum creates wealth in long term. And then this is flexible as the investment is already done. Now there's a myth in market. Many of them assume that mutual funds and SIPs are the same. But the fact is, like, a mutual fund is an investment product, but SIP is not an investment product. It is a method of investing in a mutual fund. Now let's try to understand the 25 years of mutual fund returns in both SIP and lump sum modes in India. On the left, we have a lump sum investment, which is 1 lakh, that is made in the year 2000. This was done for a long period of 25 years across 44 diversified equity schemes. This investment grew to 35.03 lakhs, delivering an annual return of around 15.29%. On the right, we have a SIP amount, a monthly SIP of 10,000 done on 10th of every month. Over the same long-term period of 25 years across 44 diverse equity schemes, the disciplined monthly investment grew to an average value of 3.66 crore with a return of around 16.74%. So what does this tell us? SIP investing benefits from disciplined rupee cost averaging and the power of compounding. Small but regular investments can create significantly large wealth over time. The key takeaway is simple. It's not about timing the market, but about the time spent in the market which delivers the value. Start early, stay consistent, and let compounding do the heavy lifting. Now let's understand which mode of investing is better. Is it SIP or lump sum? To understand this, I have taken a couple of scenarios of the same fund. Let's assume an investor is doing 5,000 SIP per month for 1 year. The total investment would be 60,000. End of 1 year, the returns generated by this fund are around 9.76%. Likewise, this 60,000, the same amount will be invested in the same fund in the beginning of year, and after 1 year, the returns are around 7.27%. If you observe here, the SIP returns have outperformed the lump sum returns. This is scenario number 2. Now let's get into the scenario number 1. Now let's get on to the scenario number 2. In scenario number 2, we have considered the same fund. 2,500 is the SIP amount that has been done consistently for a period of 3 years. The total investment made is 90,000. The SIP return that has been achieved is 34.5%. In the same fund, the same amount of 90,000 was invested in the beginning of 3 years, and after 3 years, the return is 102.14%. In this case, lump sum returns outperform the SIP returns. In scenario number 1, SIP returns has outperformed the lump sum returns, and in scenario number 2, it's vice versa. Now, based upon the previous example, it's difficult to pick up the best mode of investment for better returns. So there is no one-size-fits-all approach to investing. So SIP is ideal for investors with regular income and for disciplined investors. Lump sum is better for irregular income, high risk tolerance, or when the markets are undervalued. It works best when you have surplus funds and have market understanding. Here comes the hybrid approach, which is the approach that everyone needs to adapt to. This combines best of both SIP and lump sum. It's a combination. It combines best of both SIP and lump sum. You invest regularly through SIP to maintain discipline and use lump sum investment during market corrections or dips. The approach balances risk, opportunity, and consistency. The key is not choosing SIP or lump sum alone. The right strategy depends on your income pattern, risk appetite, and the market conditions. So, what's the final take? A well planned combination can help you achieve your long term financial goals more effectively. So, hybrid is the way to go. Do regular SIP, and whenever market dips, put in some lump sum. Everyone should adapt to a hybrid way of investing to see very good returns. Now, you might have a doubt. How frequently does market correct, and do we get the opportunity to put in lump sum every year? This chart shows the year-wise drawdowns of Sensex from 1980 to 2025. One important reality standouts. Market volatility is normal, not an exception. Out of the last 45 years, only 5 years had intra-year declines less than 10%. This means that in most of the years, market have corrected by more than 10% at some point, even while long-term returns may remain positive. The average intra-year drawdown has been around 21%. There were years where deeper corrections of 30%, 40%, and even 50% have happened. Best example is COVID, where market has corrected by around 60%. Yet the market recovered and moved higher over time. These dips are the opportunities for lump sum investment. The key lesson is simple. Short-term market falls are part of long-term wealth creations. Investors who stay invested through volatility are the ones who benefited the most. Trying to avoid market fall often leads to missed opportunities. Successful investing is not about avoiding volatility, it's about capitalizing on the volatility, having patience and discipline to stay invested and do lump sum. So that's it for today's video. If you like the content, please share the video, like and subscribe to the channel. Do contact me on this number for free advisory and portfolio review. Thank you.